Today, we are diving into a risk in the world of finance that, it often hides in plain sight. It's called structural subordination. And it's a concept that can completely flip the script on who actually gets paid first when a company gets into trouble. So let's get right into it.
I want you to imagine something. Let's say you're a lender, and you've put your money into what everyone calls senior debt. You're thinking, great, I'm at the very front of the line for repayment. But what if that wasn't the whole story? What if the very structure of the company you lent to secretly pushed you way, way to the back of the queue? And that is the absolute core of what we're talking about today. In the, let's face it, pretty complex world of corporate finance, the names and labels you see on debt can hide a very, very different reality. And understanding that reality, well, it's absolutely crucial for any serious investor.
Okay, so to really get our heads around this hidden risk, let's start by just completely breaking down one of the most common assumptions in all of lending. Right. The widespread belief, the one we all kind of take for granted, is that if you hold senior debt, you have first dibs, first claim on a company's assets if things go south. It's supposed to be the safest place to be, right? But this belief, as logical as it sounds, is very often not true at all.
So what is it? What's the thing that shatters this myth? Well, the culprit is a really powerful but kind of subtle concept called structural subordination.
So here's the textbook definition. Structural subordination happens because of how a company is legally built. Any debt that's issued by a parent company, we'll call it the HoldCo, is effectively second in line to any debt that's owed by its subsidiaries, the OpCos. And you have to ask why. Well, it's simple, because the OpCos are where the real, valuable, revenue-generating assets actually live.
Now, it's really important not to get this confused with contractual subordination. That's totally different. That's a formal, negotiated agreement between lenders. Structural subordination, on the other hand, it isn't written down in a contract anywhere. It's just an inherent fact of the corporate setup, and it's driven entirely by one thing: where the good stuff is.
To really, truly grasp this, you just have to follow the money. You have to follow the assets. It all comes down to the company's org chart, really.
Here is a super simple way to think about it. Picture a two-story house. The operating company, the OpCo, that's the ground floor. It has everything of value inside: the factories, the cash flow, the patents, the customer contracts. Now the holding company, the HoldCo, it's like a tenant living upstairs. The HoldCo technically owns the house, but its lenders have no direct key to get to the valuables on the ground floor.
And this hierarchy, this is the whole game. So in a crisis, the OpCo's creditors, the people with the keys to the ground floor, they get paid first, directly from all those valuable assets. Only after they are made whole does any, and I mean any, remaining value flow upstairs to the HoldCo. And that means the HoldCo's creditors are last. They only get a claim on whatever's left over, which, as you can imagine, could be absolutely nothing.
Okay, theory is one thing. Let's make this crystal clear with a hypothetical case. We're going to call them Alpha Group.
So here's the setup. Alpha Group is our HoldCo, living upstairs. It goes out and borrows £100 million in so-called senior debt. But its subsidiaries, Alpha Manufacturing and Alpha Services, they're the OpCos on the ground floor. They own all the valuable assets: the factories, the machines, the IP. And here's the crucial part. Those OpCos have their own lenders who have direct, secured claims against all those assets.
So what happens when Alpha Manufacturing hits the wall? Well, let's look at the numbers. Its assets are worth $150 million. And guess what? Its own creditors are owed that exact same amount. So they get paid in full, directly from the assets they have a claim on. So the value left over to flow upstairs to the HoldCo lenders? A big fat zero. The senior debt at the top gets absolutely nothing from this entire part of the business. Now, this isn't just some dusty financial curiosity. This is an incredibly critical risk factor in today's economic climate, and here's exactly why.
So look around today. We're seeing more and more complex corporate structures, a lot of them from things like leveraged buyouts. At the exact same time, you've got higher interest rates and economic pressures forcing companies to rethink everything. This means lenders are getting a lot more cautious, they're looking right past the labels, and they're demanding to know exactly where the assets are, which just magnifies this structural risk.
So, the million-dollar question is, how do you protect yourself? How do you spot this hidden risk before it's way too late?
Well, it really just comes down to asking the right questions. You have to be relentless. You have to ask, where are the actual real revenue-generating assets? Are there any upstream guarantees from the subsidiaries that support the parent company's debt? How does cash actually move from the operating level up to the holding company? Answering these questions, that's how you reveal the true pecking order.
So, after all of that, what is the one lesson, the single most important idea that you need to walk away with? Well, it's a simple idea, but it's a profound shift in how you should look at things. Here it is. Structure determines seniority. That label, senior debt, it's just a label. The real priority, the real seniority, is dictated entirely by the company's legal and operational structure. It's all about who is closest to the assets. And knowing that, well, that changes everything.